So broadly on the outlook, if we look at what really, and to summarize where the macro construct right now stands. One of the key concerns of the central bank or the RBI has been high food inflation, has been very volatile food inflation, which is making their jobs slightly difficult, because of which they've had to keep rates slightly on the higher side. But if you look at the trend of food inflation, now it started to cool down thanks to a normal monsoon. If you look at core inflation, although it's bottomed out, it started to go up, but nevertheless, given the slowdown in goods, inflation, we do expect core inflation to remain quite benign and to remain range bound. If you look at the global growth momentum, that's moderating at the margin and that's slowing down. And especially on the inflation side, things are now beginning to look very much in control, at least globally, and hence most of the major global central banks have started to cut interest rates. So as the global plus domestic macro construct becomes more favorable, we are expecting 50 to 75 basis of rate cuts in FY25. So one of the features, when we saw the yield curve of the August 2024, largely we saw a very flat yield curve. So what it means, as we see, 50 to 75 basis of rate cuts, broadly we expect yield curve to steepen. And why do we expect yield curve to steepen? So typically what happens as a precursor to, fall in interest rates, typically at that point of time, market participants usually tend to increase their duration. They prefer to be in the highest duration segment as they're anticipating, cuts in interest rates. But as we get closer to the interest rate cuts, it's typically the short end, which is anchored to the overnight rates, that tends to typically come down quite sharply, and that's why yield curve usually steepens in a rate cutting cycle. And not only we expect the 50 to 75 basis of rate cuts to help the curve steepen, we also expect, if you look at liquidity. So if you see in the last 6 months, especially in the month of April to June, liquidity was quite tight because of lack of government spending, and that's why the short end was not really performing as compared to the long end. But now, as we expect liquidity to remain easier, we expect credit growth to moderate from these levels. We do expect short end to also outperform the long end. One of the other reasons why we expect yield curve to steepen is you have a heavier H2 supply calendar in government bonds as well as SDLs. So typically SDLs have a light calendar in the H1, and typically there is higher issuance in H2. And in this year, uniquely, the government bond calendar was lighter in H1, and hence we do expect the higher supply in H2 to keep yields at the long end slightly elevated compared to the short end. The third aspect is, as we have discussed before, India is now part of JP Morgan bond index. So as we expect more flows in Indian fixed income because of the index inclusion, typically the preferred duration segment for foreign portfolio investors globally is the 5 to 10 year segment. And that's why, because of the favorable demand supply balance there, we do expect short end rates to also do well. Of course, we discussed that there is a clearer visibility of monetary easing. So as we go closer to the rate cut cycle, short end rates can outperform the long end. And hence, in this kind of a scenario, we think the moderate duration products, or basically products which are typically running duration up to 4 years, they provide the probably a better risk reward in this scenario for shallow rate cut cycle. If you look at the real bond yields today, so if you consider forward-looking inflation or average FY25 inflation, which is at 4.5%, and if you look at 3-year AAA bonds, which are trading around 7.5%, you're looking at a 300 basis points real rate. So this kind of real rate, Indian investors or fixed income investors are seeing after a long time, which we think is quite attractive, as it gives you a reasonable accrual, as well as it gives you a possibility of participating in capital gains as the rate cycle turns. So which products are suitable for investors? also depends on your time frame. So if your time frame is 6 to 12 months, then probably products like ultra short term money market or low duration are more suitable, because that's largely the duration that those products maintain. If investors have a more than 12-month investment horizon and appetite for mark to market volatility, probably they can consider 1 year plus duration to 4 year duration categories, such as short term bond fund or a corporate bond fund, uh, which can give them a reasonable accrual as well as a higher duration upside.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.